watching these meme stocks. They began the extraordinary spike back in the summer of 2020. And recently, some of these names are starting to garner attention once again. Jenny was just telling us about GameStop. To bring in our panel, Ben Silverman, Director of Research at Verity Data, and also David Traynor, CEO of New Constructs. Thank you both for being with me. So Jenny just finished talking about the fact, and everybody's talking about the fact, that Ryan Cohen, the chairman, bought over 10 million shares of GameStop. And in fact, the stock has gone from less than 150, it's at 175 or so. Ben, I'll start with you. What are your thoughts on GameStop and some of these names in a broad-based way?
Thanks, Nicole. So GameStop's interesting. You know, we deal with institutional investor clients, and we put out research about insider buying and selling. And Ryan Cohen's recent purchase obviously lit up our radar. But the important thing to remember is, so he bought about a little more than $10 million in stock. His cost basis on his GameStop investment is still, even with that purchase, a little under $9.50 per share. So when investors are looking at GameStop and wondering, is this a good price to buy at, and they see the chairman buying, they really need to understand that most of his investment was made at a sub $10 price. So $120 or so, or 100, I think he's buying at around $102. That might not be the best indicator. He's throwing down some cash to protect a large investment that he's already up 12 times.
Right. And David, your thoughts here, because I think you're making a great point about what we're seeing. It's not always as it appears, right, David?
Yeah, you know, I would firmly agree with Ben. You know, look, this is I think it's a head fake. I mean, the fundamentals of this business are nowhere near close to justify the valuation. This is crazy. I mean, that's why they call it a meme stock. I mean, this is why we have bored apes. I mean, no one even pretends that this investment makes sense. It's a speculative gamble. And as good as it can be on the upside, it can be just as devastating on the downside. And we would highly recommend that investors sell into this strength. If you have gains in it, take them. But yeah, this is it's crazy talk.
David, but are there some names that you do like? You're saying sell if you want to maybe take some profits, particularly a name like GameStop, which has jumped now, David. Are there other names that you say, oh, if this one's down, I would touch that one. I would get in for a little bit?
Not in the meme stock arena, no, not by any means. But if you're talking about sort of bigger, larger, or more solidly fundamental companies, absolutely. We've got a regular recommendation list that comes out weekly. And we think there are plenty of good spots in this market, but we still think there's some really dangerous spots. We've had a bit of an unwinding of the meme stock trend, you know, at the beginning of the year, and some other really expensive stocks have come down a good bit, but there is a lot of risk in a lot of these stocks remaining because they were so overpriced to begin with.
Ben, what are your thoughts? I mean, are there other names that you would say, hey, I might be interested? I think you made a great point in noting that Ryan Cohen's getting in there. He's buying at over $100 a share, and everybody's so excited he's buying. But the truth of the matter is his price is probably $10 or less. So that being said, AMC, for example, which we always thought of as a movie theater, has certainly expanded its role into purchasing a gold and silver mine. Are there other names, Ben, that you think that might be a play?
I mean, speaking of AMC, you know, there's a good example of look at what the insiders are doing. Everyone's all excited, but the CEO sold $40 million in the last couple of months. That's a good indicator. I mean, if he's in it for the long term, like he talks about, why is he taking money off the table now at these prices? You know, in this arena, you know, it reminds me of the dot-com boom and bust. I was involved in that both as dot-com executive and as a journalist, and things are just not running off of fundamentals here. And this idea, companies like AMC branching out and buying a gold miner today, the CEO was talking about more potential M&A outside of the core business. It's this idea of throwing things against the wall to see what sticks. And, you know, some investors are going to appreciate that, but many, you know, are not going to. And, you know, again, it's the quality of the company, it's the quality of the business. And I'm looking at all these meme stocks, and, you know, Bed Bath & Beyond's a good example. That was the stock, it still kind of is. The insiders have been buying there over the past several quarters. The company's been buying back stock. So at least we have an understanding that management is invested in the long-term health of the actual operating business, as opposed to trying to go, you know, off of plan and just throw money that, by the way, AMC got a lot of that money selling stock to the public at over twice today's market. So,
Right.
you know, people just have to be careful. Look at good companies, look at companies with good fundamentals. You know, so I tell my clients, look at where the insiders are buying or where they stop selling. Look at where buybacks are being deployed opportunistically, not just to buy back stock, but to reduce outstanding share count at good prices.
Yeah. And David, what are your final thoughts here? Because you said I wouldn't consider meme stocks. I mean, what would you consider?
You know, we like stocks like Domino's. We recently published a report on that company. Ford Motor Company, Royal Bank of Canada, O'Reilly Auto Parts, AutoZone. You know, these are sort of you're not as sexy or fancy names, but they can be trusted. And I think that's what investors should look for these days. Companies and management teams trust. And I think Ben makes a good point about AMC. Like, the management team's talking out of both sides of its mouth the way it's selling stock, throwing capital at a gold mine. I mean, throwing whatever they can at the wall to see what sticks is not good management. That's a sign to turn and run. These folks don't care about preserving shareholder capital. They care about maximizing wealth for themselves. And as Ben said, we saw this during the tech bubble, and we're seeing it again now. It's a shame. It's a shame. And there are plenty of other great companies like that deserve your capital and deserve your trust, as opposed to these meme stocks.
Thank you both so very much. Ben Silverman of Verity Data, and also David Trainer of New Constructs. A great conversation. I appreciate it. Nice to chat with you both. Thank you.